Hi everyone, my name is PK. Here I have Gilbert Melgar, who is the CEO of SuburbsFinder, which, as the name suggests, helps investors find suburbs. He's kind of like a data analytics guy. He's been into that for the 15 years, and that has evolved into him starting his own property portfolio, which is, very successful now. And he started this platform, SuburbsFinder, which, I think has helped a lot of people. I've known Gilbert. I was just talking to him before I hit the record. I think we caught up for a coffee in 2021. I did an event in Sydney, and that's the first time I met him. It just Gilbert struck me as like really unassuming, sort of humble individual. And I don't know why it's taking this long, but we're finally doing an episode together. But in this episode, okay, here's the hook. We're gonna talk about 3 to 5 worst suburbs to buy in Melbourne. 3 to 5 worst suburbs to buy in Melbourne. In fact, I posted in my Facebook group this morning, Australian Property Mastery with PK. Hey guys, what do you think the worst suburbs are to buy in Melbourne? And some of the responses, just before we get into the episode proper, people responded Tarneet, Melton, Deanside, Kalkello, Beveridge, Thornhill Park, Donnybrook, Rockbank, Deanside again, Docklands, South Bank, Yarra, Sorrento as well, one person said. So even before we get into the episode, guys, if you have an opinion, strong opinion, weak opinion, doesn't matter, about worst locations in Melbourne to buy property right now, put that in the comments. I'm keen to hear your perspective and the reason, the rationale as well. But Gilbert will also share this from a multi-dimensional view because he's a data analytics guy, like I said. So he'll take a completely objective view on where maybe people don't want to be parking their money to make money in the near and long term, where it will likely underperform despite all the consensus, majority of consensus right now being that Melbourne will do really well over the next 3 to 5 years. Where do you have to be cautioned about? Gilbert, thank you so much for coming. I really, really appreciate your time.
Thank you for having me, PH. Yeah, as you said, it was a long time, first time, because we met 2021. That was a really long time ago. That was the time that I just launched the platform as well. Yeah,
Yeah,
that's
I
how
think.
successful you are now.
Oh, no, thank you. I should also say to our audience, which I forgot to before, towards the end of the session, Gilbert is going to take us through a particular tool from his website that will illustrate the power of compounding. You'll use a portfolio, I think maybe my portfolio, to share how a property portfolio looks after, let's say, 1 year, 5 years, 10 years, and beyond to give you further understanding of why it's so important to pick the right suburbs, and if you do, just how much they can multiply and exponentially increase your wealth over time. But we'll get to that.
Welcome to the Oz Property Investment Mastery Podcast. My name's PK and I help busy people build passive income by buying top 5% growth and cash flow property and build a portfolio using data without wasting months doing research, spending weekends at inspection or catching flights, or dropping $10,000 to $20,000 on buyer's agents every single time. So if you're confused, lack confidence, and just overwhelmed with all the information and marketing misinformation available online and don't know where to start, then this show is for you.
Let's start from the start, Gilbert, and feel free to take the stage. I'll interject anytime that I want to, but please start with with maybe your first suburb in Melbourne.
Okay, well, before I start, probably I'll just what do you call this? Start with what are the reasons how I came up with the list, right? So, basically the fundamentals. So it's all start with the fundamentals, and so we always say supply and demand, the relationship. So that's pretty basic. So it's not rocket science. We're not gonna complicate things. So one of the reasons is too many sales in these areas, and lo- homes are sitting longer in the market. Right, rents are not growing, and prices are just stalling. So not really. hasn't shown really increase in price movement. And one of the future metrics that we're looking at as well is the lots of development applications getting approved and lots of house being built. And infrastructures are not yet in there. Everything is just, even though it's been announced, but the status it's still on planning. So when that status has changed, so everything gets will be different. And so those are the key ingredients that I use to come up with the list. First on my list would be rock band. And then on my list, we have here 615 the median house price. Next would be Windham Vale. Third, Mickleham. And fourth, Beveridge. And Werribee South. So for all the people that are listening on the via audio of the podcast, all of these suburbs here, the lowest vacancy rate is 3.25 for Werribee South. And then the next would be Mickleham at 4.84. And Windham Vale, 8.76. And Rockbank and Beveridge both are on 19% vacancy rates. So that alone, we can see that it's not a good market for rentals, right? Because there's a lot of supply in terms of rental property in the market. Okay. So if you're buying that, then you're going to have, of course, you're going to have an issue with cash flow, right? And next would be the yield. So yield would be the lowest with 3.9 and the highest would be 4.30. So imagine that combining with higher vacancy rate and lower yield, then you're really going to expect that your holding cost will be really, really high. Next, we have our rental days on market, even though it's pretty normal, under 40 days for all 5 suburbs. We can see that let me just show here. We can see here that the rental listings for houses has been high, except for Werribee South. You can see here that there's a lot of rental properties, which is the reason why the vacancy rate is high. And the one I was saying a while ago, one of the reasons why I picked these 5 suburbs to avoid is because if we look at the trend, hasn't really in recent price hasn't really gone up for since January 2022. It has plateaued. In fact, Werribee South has gone down since September 2024. So those are one of the metrics that we look at, and also looking at the inventory levels. So the current inventory levels are, let me just pull that in. So the current inventory level sits, the lowest will be 5.2 for Windham Vale and Mickleham at 8.2. So that's 8 months. Right? And the highest would be 18 months for Beveridge. So that's really, really, really high, right? And then stop on market percentage. So at current, so we can see here, we can see the trend here. It's always been up, or even pre-COVID, it's always been above 3 months. But lately, started August to September 2024, inventory levels has gone up for all these 5 suburbs. So if you look at realestate.com.au or domain, just type in the suburb, you can see there's a lot of stock in the market, and more than half of the stock are newly built, or some are land house and land packages. Yeah.
And I think that's one really important reason I wanted to do this episode as well, because in most, if not all of these suburbs that you're sharing, we see that investors constantly ask about them. Are these good locations to buy? On my YouTube comments and my Facebook group. And I think the reason they're always asking about them is because they're seeing all these ads from different buyers agencies who sell brand new house and land packages or, off the plan kind of townhouse or whatever it is. So they're having these like free strategy sessions, clicking the Facebook ad with all these kind of dodgy outfits who are really a dime a dozen. And then those people are selling them the dream that, buy a brand new place in Wyndham Vale and Werribee and this and that area, Beveridge. It's going to give you amazing tax depreciation benefit because it's brand new. Because it's brand new, it's going to
Yes.
also mean easy tenants, rent rises. There'll be a rental guaranteed, zero maintenance. For a new investor who's not educated, it's like cha-ching. Like, I don't know who this property investment company is, but I'm onto something. But scratch the surface and you talk to someone like Gilbert, and it's like, all right, yeah, that's a massive scam. Do you come across that kind of thing as well, Gilbert?
Yes, yes. I every day with people that I spoke to, people that I work with, friends and relatives, because I think they saw, what do you think of this? Because this is a nice house, and when we check, it's a nice house because it's new, right? And the selling point is depreciation. We'll get a lot. Well, but the thing is, I mean, I don't know if you'll agree with me, but I think highly likely you will because depreciation shouldn't be part of your strategy. Eh, In fact, it's just if the depreciation is there, it should be just considered as a bonus.
Yeah, yeah. And like I think it's, you just have to go to the ATO website, Australian Tax Office website, and realize that if and when you sell that property, and like this amazing stat, Gilbert, I don't know if you know it, I only found it out recently that the average property investor only holds their property for like 2 to 3 years. For me, that blew my mind because like I've basically never sold any of my buy and hold properties for over a decade. And it's like, if you buy well, it's a golden goose. It's going to give you passive income. It's going to lay eggs. So they're either speculating or they made a really bad decision and now they're offloading. But the point I was making is if and when you sell that property, you have to add all of that depreciation benefit. It could be hundreds of thousands of dollars back onto your asset base. And that will also be in the mix, in the calculation for ultimately calculating your capital gains tax. So your tax, you still have to pay tax on a large chunk of it. And I don't think the property investment companies tell you that necessarily.
Yeah, that's what they don't realize that when they sell the property, that depreciation that they already collected goes back into the base. Right?
Yeah. Yeah.
So they pay tax on it. That's the main reason why not a lot of I'd say not a lot of real estate agents or people who selling house and land packages don't really discuss that part. Because for them, this is our stuff. We just need to sell it to you. And after that, okay, thank you.
Yeah, and I want to be measured as well in this commentary, and I know you're always very balanced in your perspectives, Gilbert. In a nationwide property boom like we had during COVID, like say in 2021, even the worst investments that don't follow the fundamentals, they rise. And I know there'll be people watching, listening to this thinking, PK, here you are again, bagging house and land packages. But I bought a house and land package in Northwest Sydney, or I bought a house and land package in, I don't know, near Ipswich in Brisbane or wherever, and it doubled. So I don't know what you're on about. Like, all kudos and credit and congratulations to those people. But in times when there is not a nationwide boom, i.e. prices aren't increasing 20% basically everywhere, the fundamentals prevail. And I think that's really important for new investors to understand, especially those maybe of a migrant variety who have this natural tendency to go towards new. I think a lot of migrants, I don't know, like from different Asian countries, whether it's the same or not, Gilbert, but like definitely from India and the subcontinent, it's kind of looked down upon to buy like a secondhand thing. And I think that mentality carries forward into Australian property investment where they're like, an existing established house? Like, no way, I'm going to buy the shiny brand new thing, not realizing that building standards are nowhere near what they were like 20 years ago. And a brand new house is structurally way weaker than something built like 30, 40 years ago. Is that also the same kind of mindset, from migrants and, kind of where you're from and your community, Gilbert?
Yeah, yeah, definitely. I totally agree with that. Robot, your origin is from India and definitely from the Philippines. Well, I'm a migrant as well. Yeah, I totally agree with that. And not. I don't have anything about house and land packages. I mean, you're right. Most of people who bought 10, 15 years ago have already doubled, right? But yeah, when there's no cycle boom cycle, or it's not really on a period that everything's compounding, and that's where fundamental really important, right, to get it right when you're buying. And I think the only time that for me, as able, we all have our different strategy, different opinion. The only time that I'll buy is if I'm gonna buy a house and land package, is if I'm just gonna put in not a down payment, but a reservation, and then the rest would be after settlement. Because that's a good deal already, right? Rather than putting in or paying the developer every, like, stage one, stage two, stage three, right?
Yeah.
Those ones.
Yeah, and you better
And
be
of course,
careful if you do that to get a good builder, because a whole bunch of them go bust, and it's a big
yeah,
headache.
definitely. And I totally agree with you. Houses that were built 20 years ago compared to now are totally, you know, different. I'd prefer the houses that are built 20 years ago, especially the double brick ones, right? Because if we go around, I mean, the double brick ones, they've been there for more than 50 years, 80 years, some are even 100 years. So it's tested, battle tested already in terms of the property cycle and in terms of weather and all.
No, 100%. They don't build them like they used to, as they say. Just before we go to your tool on your website and around compounding, I just have this question. I noticed that Rockbank, which is one of the 5 suburbs that you mentioned, is kind of halfway, somewhere like between halfway from Melbourne to Melton. Now, I'm not judging, but I'm just reading a comment that someone made on my Facebook group, and they said Melton is going to boom because of so much infrastructure going in there. So surely everything on the way from Melton to Melbourne will also boom, because those are all places closer to the city. Um,
Mm.
I'm just going to stop my statement there and let you respond in any which way you want.
So the statement would be from Melton, so it will have a ripple effect, I'd say, on the nearby suburbs. Is that right?
I may not agree with this, but they're saying that there's so much infrastructure going in Melton. Of course, it's affordable. It will boom, and therefore places like Rockbank, which is one of your 5, will also boom because they're actually closer to the CBD than Melton.
Right. So I would say yes and no. Yes, it would be possible to happen if if all the stuffs in Melton has already been depleted. Right? Right. That's the only thing that I'd say it will work, or it's gonna be a fact or truth, right? But I'd say no, given that there's so much stock in Melton right now. Right? So when if and when that happened, I think it will take a good 3 to 5 years, right, before that happens. So that's my answer to that. Yeah.
I think that's a good answer. And I think, Melton is already rising. And I think we have to be fair on looking at the data. Parts of Melton are rising. And I think they will continue rising because of the first homeowners grant, the scheme, the
Oh yes.
5% deposit scheme. It's affordable. And although I've quote unquote trash talked Melton a lot, like, when government policy changes, that also has an impact on different suburbs. The affordability story plus this new scheme, which doesn't have any income caps anymore, is going to help Melton. But I still maintain that compared to the best suburbs in Melbourne right now, which over the next 12 months, the best suburbs in Melbourne will go up between 10 to 30% in the right dwelling type, Melton will underperform. And I think it's really important not just to buy for, okay, it's going to grow in 4 to 5 years, but we want something to grow right now. And that's because compounding means whatever grows more now is likely to give you even more gains in the future, because future gains come off already more current or very imminent gains. And maybe that can be the segue into the next phase of this episode, which I wanted to give you an opportunity, Gilbert, to showcase this cool tool that you have that shows just the power of compounding. And as you get that up, Gilbert, I just want to reiterate, so many people in my Facebook group that are in their 30s and 40s, they say, I wish I learned the power and the phenomenon of compounding in my teens or in my early 20s. It's a very simple thing. Like, it's so simple you can miss it, but it's so powerful. Go ahead, Gilbert.
Yep. While I prepare that, well, totally, I agree with you, right? So the person who who buys on a better location definitely will beat anyone in who buys in other parts because of the compounding effect, right? And it's not only that. Compounding lets you scale your portfolio. So this is our portfolio analyzer. So this is just one of the tools that we have in here. So in terms of this, so I look at your video and I just plug in all the numbers that you shared in your one of your YouTube episodes where you uh, showed your whole portfolio. Okay? And I mean, that's really great that you're being transparent to people. At least they don't have they can't say anything about you at all. Like, is your portfolio here? Here's my portfolio, guys. I'm being transparent, and here are the numbers, right? So I plug it in here, right? So all the address that I put in here, these are just addresses within. These are not your exact property, but these are the prop addresses within those suburbs that you mentioned, right? So looking at this, so I just put here 60, because I don't know what would be the deposit, so I just put here in 40 to 50 or 60 LVR. Right? So looking, we can see most, not most, but I put there 10 out of your 13 properties. So the ones that I did not put are the one in the US, the one in India, and your principal place of residence in Gold Coast. So I just put here all the investment properties in here. So looking at it, so all of this, if you look at it, all of these are green in terms of estimated cash flow before tax. So these are all positively geared already because you started buying at 2011, right? So it's, and then every year you bought 2015, you bought two, and 2016, you bought two again, 2017, and then 2021, you bought two, right? So, and then from those 6 to 10 properties are all positively geared, right, at the moment. So, looking at your total purchase price, let's say you bought all those properties, that's amounting to 4.3 million. And your current market value now is 9.3 million. That whole portfolio. So LVR is 41%, and your portfolio equity, it's 2.5 million. So this is just the deposit you have used to buy all of those 10 investment properties, your mortgage, and of course your cash and cash return of 3.62%. So your portfolio value is 9.3. The growth has been at almost 5 million, which is 4.9. And your total current equity is 7.5 million for all those property. Wow. That's congratulations to you. 7.5 equity. That's really, really impressive, man. So, it's a lot to digest looking at all of these numbers, but if we take this analysis in here, we can see here the summary of each of your property. How did it perform individually, the property itself versus the suburbs performance. So you can see here that your Gosford property is 8.48 compounded growth rate from 2011 up to the current year, compared to the suburbs 10-year compounded annual growth rate of 6.2. So all of this, all of the property that you bought has pretty much beat all of the suburbs 10-year compounded growth rate.
Except for Mount Sheridan, which was a disaster. Look at that.
It's not bad. It's 4.97 compared to 5.01.
Oh my God! Things would be different if I hadn't followed some news articles and new casino, Hong Kong billionaire investing in Cairns.
Well, I'd say 90% is, you should be really happy with that. Right? Is that? But still, it's just 0.0. But yeah, I really totally get you where you're coming from. If this could have been, if you bought into a different location, this would have been what, at 6 or 7% growth rate. Right? Yeah. And looking at here's how diversified your portfolio is, right? So 52% of that is in Queensland. So that's equivalent to 4.8 million. 22% of that is in New South Wales. And in Victoria, that's 12%. And in Tassie, that's 14%. That's 1.3 million. So this is how diversified your portfolio is, right? But the most interesting part, I was blown away when I put in your numbers here, is when I look at this, right? Your journey. Because in here, you started buying at 2011. So from 0 to 9.3 million in 14 years. So 2011, 12, you bought again. So these are the years that you bought your property. And now it's 9.3. That's it. So provided that the growth rate continues, so this is what it will look like in 10, in 5, 10, 20, and 30 years time. So you are now what? 35? We were just talking a while ago what our ages are. And you're definitely way younger than I am. So at 65, right, provided that the growth rate continues, your whole portfolio would be 60.5 million. Imagine that, right? I was blown away with that.
It's hard to imagine, to be honest. I think probably people who are in their 60s now would never have imagined that their properties would have done what they did in the last 40, 50 years. I mean, when they were buying in Sydney for like $20,000 in the 80s, they probably weren't imagining that the average house price would be close to $1.5 million in Sydney by the time they're 60. But yeah, this is, land is scarce. They don't build more of it. This is a really powerful
Well,
chart.
there's a lot of people saying, good luck if I reach even reach age 50 or 60. But let's say, right? So even after 5 years, right? That will be 11.5 million. Or let's say 10 years time, right? So in 10 years time, it will be what? 45? And your kid will be just started to in high school, and that'll be like 16 mil. That's crazy.
Yeah, it is crazy. And I think that like this is crazy in of itself, but the crazier thing is even that like these are just kind of like long-term averages. I think people can invest way better than I did, to be honest with you, Gilbert, and you probably know people who have much better or bigger portfolios or accelerated faster than I did. But the reason I am able to have my PPORs on top of this and also LVR of 0 right now is because I did property development. So I mean, I don't want to tangent into that, but this is just like average stuff. Like you can do better than this. Do you know what I mean? And I did better than this as well, and that's why my LVR is 0. But you can you can kind of get to this level faster. Because like I said, I made mistakes. My Mount Sheridan one was pretty terrible, and there was a couple of other properties you shared there where, like the growth rate was like around 6 or 7%, which is like good. That's the long-term growth rate for Australia. And yes, I got the early gains, which helped the power of compounding. But you can actually get 8 to 10% growth rate, average growth rate over
Yeah.
a 10, 20 year period. And people are doing that. I didn't do that as well as people are doing that right now using data.
So yeah, because you've already proven that. Because look at I'd say 9 out of 10 of your investment properties in the portfolio, all of those has beaten the suburbs compounded growth rate performance. Right? So these numbers here, the projections are based on the suburbs compounded annual growth rate. But given that all of your property has performed above than the suburbs performance, so they highly likely there's a possibility that these projections are going to be is conservative. So it's going to be higher, right? Or the possibility would be higher. It would be higher than 11.5s, higher than 16, higher than 30 mil, or even higher than 60 million in 30 years time.
Yeah, it's mind-numbing numbers, really. But there's a saying that comes to mind that, when it comes to the stock market, buy the haystack, not the needle. Because it's so difficult to pick the right, stock out of so many. But when it comes to property, buy the needle, not the haystack. You can't buy a city like Melbourne. You can't even buy a suburb. You can only buy one property on one street, and, as they say. So if you pick the needle in property investment, you can do far better than me. Honestly, I think my results should just be used as a baseline, and people should try to beat them because I think everyone can do that.
Yeah, definitely. Well, you've proven it already. It's just they just need to be educated, right? So that's why you have the community and you have the education system to help them with that. Mm.
Awesome. Well, you've been so helpful, Gilbert, both on the illustrating the compounding growth tool that you have on the SuburbsFinder's website, which is what you run there, and also sharing with the worst suburbs in Melbourne. But Gilbert, was there anything that I didn't ask you, or anything that you want to share before we wrap up?
Uh, no, it's only one thing that I would share is, when I plug in the numbers there, I was inspired with your portfolio. So I guess if I was inspired, then a lot of people who've seen this would be inspired, should be inspired as well, right?
Yeah. No, I think that's a really good call out, and I'm reading here because I wrote this down. I wanted to finish on this. It says information plus reflection plus application equals result. So just by watching or listening to this, you're not going to get the result, right? You'll be inspired, like Gilbert said. Information's good, but reflect on it. Like maybe discuss with your husband, wife, or significant other. Show them that chart that Gilbert did. Maybe that creates a business case to convince your spouse to get on the property investment journey. Reflect, like ruminate on it, and then application. Then you actually have to do something. You can't just be on the sidelines thinking, thinking, thinking. And Gilbert's, website, along with so many other tools that are like online for free, honestly, you know,
Yes.
they are to be used to apply what you've learned. So information plus reflection plus application equal results. So make sure you follow the equation. Otherwise, it's kind of just, yeah, infotainment.
Yeah, that's totally or just think of it, what will happen if I don't do anything?
Yeah. An opportunity cost of $60 million as per that chart, apparently.
See? Good word. 60 mil, right? That's what I'm gonna lose if I don't do something. But if I do something, at least I might get like 11 mil in the future, right?
Yeah.
That's better, way better than not doing anything.
Yeah. Or like forget 11 mil, even like if you make $100,000, by investing in a 400K property, it goes up to, 4, 5, 600K in the next 2, 3 years. Even that is something, I think everything has its place, and that gives confidence to then take the next step. But I think you've really helped everyone. I really appreciate your time, Gilbert. I know you kind of rushing around. We're doing this in the morning. You just had to drop off your kids. So I really appreciate you making time for me.
No, thank you. Thank you for having me here. Appreciate it.
And thank you everyone for watching and listening. Once again, this is Gilbert Melgar. Terrific website, SuburbsFinder. Go check it out and hit the subscribe button, give it a like, and please share this with someone who might be just on the brink of making a mistake in buying in one of those 3 to 5 suburbs in Melbourne. Thanks everyone. Catch you later.